called Africa Investor Magazine, and is also in a number of infrastructure consortiums that are very heavily involved in infrastructure and alternatives, but he couldn't make it. They had a deal negotiating session today, so I'm going to just take these up for him. So this session looks at alternative investments. I know pension funds have been known to focus exclusively on, bonds, and investing in the stock market, but due to their very nature, pension funds have a kind of a long horizon, and alternative investments present a very good opportunity for funds that are looking for long-term risk-adjusted returns. And in this scope, we're looking at, investing in private equity, like Vasiliki just alluded, real estate, we're looking at infrastructure, and we need to see what are the kind of alignments that are in this space, whether pension funds could go into this. I know Sandeep just took us through their consortium that are trying to go into that space. Obviously, when you talk of alternative investments, we want to look at the risks that are involved, the asset classes. We want to look at, regulatory and supervisory guidelines for investment. We want to look at diversification options. We look at opportunities in Africa. So without further ado, I want to get my panelists on board. Okay. I've got Sandeep should join me, although he wants to get back to Nairobi. I don't know whether we'll get him online. Has any of them joined? Okay. I can see Cabello. Cabello, welcome.
Hi, Stephen. Thank you. How are you?
Well, good. I want you to do a quick introduction of yourself. Welcome to the Africa Pensions and Retirement Summit. Cabello is Managing Director of Accession Capital in South Africa. So just go ahead as I get my other panelists on board.
Okay, thanks so much.
Okay, just hold on. I can see Derek as well. Derek, welcome. Derek, check your audio. Check your audio.
Thank you. Good morning, everyone.
Morning. Derek is the CEO of Stanlib Investment Managers in South Africa. Welcome. So let's start with the introduction of Cabello.
Okay, thanks, Stephen. So yes, my name is Cabello. I'm the executive manager of Ascension Capital Partners. It's a South African-based private equity fund. It's a first-time fund that we are raising. We've been around for the last 2.5 years. By way of background, I'm an attorney by training. I've spent a lot of time at various institutions and asset managers, including the Public Investment Corporation, which is a South African manager for public sector funds. Yes, most recently, over the last 2 years, we've put together a fund management business, and that's where we are currently. Thank you.
Thank you very much. I can see my friend Maurice is also joined. Maurice, can you hear me?
Yes, I can hear you.
Okay, Maurice, you could just do a brief introduction to our online and the live audience. Just introduce yourself.
Okay, greetings everybody. I'm Maurice Madiba from Cloud Atlas Investing. We are involved in Pan-African markets, about 13 of them, through a vehicle called Exchange Traded Funds. Our business is based out of Johannesburg, but has exposure to 13 other African markets outside of South Africa.
Okay, thank you very much. Derek, you could also do a brief introduction on yourself.
Good morning to all the listeners and the participants. My name is Derek Msibi. I'm CEO of Stanlib Asset Management. Stanlib Asset Management is an institutional and a retail asset manager In South Africa, we look after about 560 billion rand of client money. We run multiple strategies from listed, or what people refer to as traditional investments, to index investments, including ETFs. We also run an alternatives business. We've just closed our second infrastructure fund. Our first infrastructure fund was set up in 2012. It was a 1.2 billion rand vehicle. We've now raised 5.6 billion rand of our second infrastructure fund, is at the end of our second close. Thank you.
Oh, that's great. So we are waiting for Sandeep, but we can kick off with the ones that are present now. I think I'll start with Cabello. Cabello, you've got quite good experience from PIC. PIC is very heavily invested in infrastructure in South Africa and Africa. And moving on to your current organization Accession, can you take us through what pension funds could look at when they think of investing in alternative investments?
Yes, no, absolutely. So maybe I should start with an anecdotal note. I mean, I had a discussion with my mother recently, who's in her 60s. She's fast approaching retirement. She's a professor at a US university. And she highlighted a point to say, you know, why is it that one has to wait until retirement before getting any benefit from, you know, your years of hard work and savings that you've accumulated? And, you know, it sort of struck a nerve to say, you know, this is something as an industry body we should be thinking about more in terms of how do we empower our members? How do we benefit them, not just at retirement, but now, currently, you know? So I think, you know, a lot of the speakers earlier on had spoken a little bit about diversification, and also just in terms of moving away from a culture of savings to a culture of investment. You know, we are able to make an impact within the broader societies and communities that we operate within, you know, be it in healthcare, education, food security, you know, various industries where we can actually make tangible differences. Maybe just to bring it back a little bit though, I mean, I think the traditional approach to retirement funds has been limited to 3 core asset classes, namely, you know, listed equity, bonds, or fixed income and money market accounts. The point that I wanted to make is, you know, really that there are so many alternatives out there, not just private equity, but, you know, hedge funds, cryptocurrencies, you know, crowdfunding instruments, infrastructure, real estate, the list goes on. One of the challenges that I've seen as well is that, you know, from 2006, certainly within South Africa, from a listed perspective, there was a big rise in the number of listings on the Johannesburg exchange. And literally, you know, you fast forward 10, 15 years later, and the number of listings has gone down considerably by up to 40%. So, I mean, that tells you that there's an entire industry that's simply not accessible because funds are locked in listed equities. So there's all those companies that have now delisted. You know, I think funds need to start rethinking the strategies to allow for greater allocations to alternative investments, such as private equity, venture capital, etc. You know, again, just anecdotally, the SAFCA 2019 report, that's the South African Venture Capital Association, you know, they tracked the performance of listed assets and private equity. And the reality was that over or since 1999 to 2019, private equity as an industry has, returned over 9.2% in compound annual growth rate, which is considerable, and it does actually outperform listed stock. So you can see there's a lot of benefit in terms of diversifying and looking at different asset classes, spreading risk, protecting capital, and obviously having some sort of a social impact. Yeah, so I think I'll leave it at that for now.
Okay, I will move on to Derek. Derek, with your experience at Stanley Asset Managers, I want to find out from yourself what kind of returns and what kind of opportunities can pension funds look at going into infrastructure or any of the alternative asset classes across Africa. Can you just give us a run through on what they can expect?
It's very difficult to say what clients should expect because it depends on the region, first of all. It also depends what time frames are they looking for. These assets tend to be long dated. You can't be using 2 or 3 year, for that matter, even 5-year returns to measure the success of some of these investment strategies. If you're investing, for instance, in a toll road, that's got a concession agreement underpinning it, you're taking a 20-year view. And so every year or so to sort of try and measure your returns on a short-term, on a short-dated basis, you end up making the wrong decision. So I basically look at them on the basis that you're going to be looking at least a 7-year type of window to have a sense around what is a sort of reasonable return you should expect. My guiding principle to the way we manage and the way we market our funds to clients is that you should expect a premium to what the listed equities actually give you over a time period. And that premium to listed equity after costs, okay? Remember that private equity or infrastructure costs are higher than what you pay a manager who's looking after your listed equities. You should be getting anywhere north of 500 basis points above what the listed market actually gives you. If a return from any of these assets after cost is less than 500 basis points above what the listed equities is doing, the risk that you're taking, the liquidity, etc., is actually not worth it. And so when I hear statistics about comparing the listed equity market to private equity, etc., I've just got a very simple view, which is what is the acceptable premium that an investor should expect over listed equities. And if that premium is not more than 500 basis points or 5%, I don't think it's actually adequately justified to be investing in those asset classes. So that's how we position it to our clients. We position it on the basis of a time period, not less than 7 years, but at a premium to listed equities, and that premium should not be less than 500 basis points.
Okay, moving on to Maurice. Maurice, I know you got an equity kind of stock exchange traded fund. I wanted to get just an idea of what you could share with our audience here and online on what you're offering kind of takes or what it offers to pension funds or institutional investors in Africa. Could you just take us through your offering? Maurice, I think you're muted.
Sorry, I was talking to myself there. Exchange traded funds are relatively well known as an investment class for investors, particularly investors abroad. However, when you look at your African pension funds, exchange traded funds are not a tool that they use quite a bit, which is why from time to time they're classified as alternative investments. However, your exchange traded funds do offer, when they look at African equity like what we do at Cloud Atlas, exposure to a basket of listed African companies across 13 different markets. And when you look at what some of these companies are doing and the sectors in which they are involved in and influencing, it's really great for a pension fund to be able to access that real growth through this basket of shares, and then also have the liquidity that is provided by equity markets, whereby they can get in and get out in a reasonable time frame. Typically, alternative investments are considered unlisted and private equity and venture capital, and a lot of pension funds then appoint skilled managers to look after that. But there tends to be some lock-in periods, which they experience, which are around 5 to 7 years, I think, as I heard Derek saying, and then they offer you the returns and that liquidity after that time. Whereas in an exchange-traded funds, you get what you know as a distribution every quarter. So as these listed companies do very well, and this is across countries, you are then able to reap the rewards of that within the very short term. And for pension funds that are planning their liabilities, maybe they've got an aging member base and they need to be able to have liquid cash on hand very quickly. This is a great alternative for them to get access to high-performing assets, liquid assets, transparent assets, and then also access to companies which may not only be in their specific country, but also be operating in other markets and consumer segments. So the parity between your listed investments in our particular ETF being the big 50, and then what you have on your unlisted investments, which is private equity, you would find, and I think Derek pointed to it, that your stock markets are trading a lot lower in terms of valuation than you have in your private equity investments. And so it speaks to a couple of things at this particular point, but one of them is the liquidity that's provided by pension funds into African securities and African stock markets. Most of our liquidity actually comes from abroad. So investors in London, investors in the United States, and very little comes from local pension funds. So you would find that liquidity starts to be a bit of a problem and creates this discount to listed equities versus private equity. Then when you're looking at other things, as Cabello had mentioned, you know, you're speaking to his mother, she wants to retire. You compare how our ETFs are and our listed equity markets are versus American markets, which have been doing phenomenal returns, nothing shy of 15% per annum. And most of that return is captured in the S&P 500 index, and S&P 500 exchange traded fund. So for us, we always look at the big 50 as Africa's S&P 500 because of what it then offers the investors. But what you typically then find is the premium in which you enter your private equity transactions becomes a lot higher. And the reasons for that is also comes back to liquidity. Because private equity and unlisted investments are not selling or exiting in the stock markets, and we're not having a high number of initial public offers, they are then forced to pass on their holdings and investments to other private equity managers and potentially do so at a premium in order to give you that return. So there is a symbiotic relationship that should naturally exist between unlisted and private equity and also listed investments and funds. And so what then an ETF provides, and our ETFs, what they do is they then provide the investors with that ability to track the performance, the growth, the consumer markets and segments, even infrastructure and development on the African continent being done by some really big players. So your risk, your counterparty risk, really lies with the big names listed on the stock exchange. And then also for private equities to have enough liquidity in the stock markets to efficiently exit investments and then provide big returns to investors. When you look at even Asian markets who've caught on to this phenomenon very well, you would know of Alibaba with Jack Ma and also his IPO of the Ant Group. Also businesses like Uber and Airbnb, which are scheduled to be listed soon. These businesses then go through a series of investment from private equity fund managers, and then they come and exit on the stock market at huge multiples. And post their exit on the stock market, they become included in an index, and they're now in a very safe phase for investors to be able to buy it, which is growth, which is stability, which is where they're paying dividends. And so that's in a nutshell what we do, is we are on the other side of this symbiotic relationship. But to date, for African pension funds, this asset class has been relatively muted. So there's a slide which I have which shows the number of ETF listings in African markets and on African stock exchanges, which is relatively low outside of South Africa. And then when you compare it to the rest of the world, we pale in comparison to this type of alternative asset class or this investment vehicle that investors can have access to.
Okay, I'll move on back to Kabelo. Kabelo, we've seen trends across Africa where even when the asset allocation kind of in each jurisdiction allows a quite a good percentage to invest in alternatives, pension funds are still shy from going into private equity, going into infrastructure. They don't allocate even, let's say, the South African regulation 28, whatever it offers you for offshore, I think, Nicola, that should be 30%, which 10 should be in Africa, rest of Africa.
30+ an additional 10.
For Africa, yeah. So with that, we are still seeing pension funds not kind of exhausting this allocation. What do you think would be the fears? Because it's a well-documented reality that there is good return on this investment.
Yeah, no, absolutely. Look, so I think there's a couple of things. I think it comes down to lack of, or maybe a misunderstanding of different asset classes. So I think on the one hand, a lot of our industry tends to invest in what they know. I think given the current climate that we operate within, it's clear. I mean, 2020 was a bit of a rough year for all of us. I think we all learned some very important lessons in terms of, nothing is certain, and take nothing for granted. So within that context, we are living in a new landscape, and I think that should be reflected in the way that we treat, member benefits and.
Oh, have we lost it?
Just because something has worked historically. Can you guys hear me?
Yeah, we can hear you now.
Okay, sorry, I don't know what happened there. But yeah, I think my opening salve was really just to say, I think it's it's a case of stepping outside of your comfort zone, and I think there's perhaps a lack of information that is made available within our industry about the different options that are there. I think the ETFs, cryptocurrencies, crowdfunding, all of these sort of different asset classes or potential alternatives are things that as an industry, I don't think we have enough knowledge on to make informed decisions around benchmarking and allocating funds and resources to those assets. I think that's the first thing. I think secondly, another challenge is that, especially within the private equity model, is that you're effectively taking a 10-year view on a fund and a fund manager. And what I mean by that is that there's no daily pricing. One cannot check an index on a daily basis to see what the value of your investment is. Typically, assets within private equity are obviously illiquid because of the long-term nature of the investment. But equally so, the assets themselves become tricky or difficult to value. A lot of fund managers would typically only value the portfolio, you know, perhaps once or you know, perhaps even twice a year. So I guess from an asset management perspective, you know, these are all the risks that one has to take into account. Another one that comes to mind is you know, alternatives tend to be unregulated as well. So again, that level of certainty around you know, regulation and knowing that you know, there is good governance and you know, there's frequent reporting. You know, I think by virtue of having alternatives or instruments that are not regulated, I think that in itself, or let me not say not regulated, but the level of regulation relating to things like conduct standards, fees, you know, it tends to be a little bit opaque and at times uncertain. So I think those are some of the contributing factors that make things or make us as an industry reluctant to explore and try different assets.
Okay, do I still have Simoli on the panel? Simoli, is he there? Simoli, can you hear me?
I can hear you.
Okay, Simoli, your experience in SADC, I'm sure you've had a couple of engagements with pension funds going into alternative. Can you just, take us through what your experiences are and what has been the key hindrances for pension funds going into alternative?
So what I find in the region is that there's a lot of hesitance from the pension funds to invest in alternatives. But you also find that the regulations themselves prohibit the investments into alternatives. But the interesting part is that most countries are more willing to externalize their money on the stock exchanges of foreign countries, when in actual fact, the need for money to be invested is in their local countries. So I think just adding to what my colleagues are saying, it's probably because the regulatory framework or the governance for alternative investments is not as robust or is not as transparent as what you find with in the listed markets. So it would be important for any market to start looking at how they can strengthen the governance structures around alternative investments. But I do believe there's value in considering alternative investments by pension funds.
Okay, Derek, I wanted to find out, Stanley Asset Managers, you've got quite a good track record. What has been some of the opportunities that maybe have involved pension funds in Africa for Stanley?
We focus mainly on infrastructure. We've tried to do other forms of alternative investment strategies, such as agriculture, such as real estate, and we've not been successful. So our view has been in infrastructure, we've had overwhelming success. It seems that's where the demand is. Whatever study you do, it shows that Africa, or for that matter, any part of the world, has actually underinvested in its infrastructure. And that is a worldwide. You can go ask the World Bank, you can ask economists. All of them I will tell you that generally the biggest opportunity you see is actually infrastructure. And the really big deficits and the things that will move various economies are what you do in infrastructure, whether it's power, whether it's transportation, harbors, roads, storage, et cetera, those are the things that are real assets, which are absolutely critical for the functioning of most economies. And so we see that as probably the biggest and underinvested opportunity. We don't believe that's going to change. We actually believe that even if you invested at the rate that we are seeing in our second fund for the next 10 years, you would not make a dent on the infrastructure deficit. Because governments over the world and in Africa in particular have not invested enough infrastructure because they don't have the money, but also the framework that is required for some of these investments requires policy certainty. In other words, you've got to be sure that if you're asking investors to take a 15 or 20 or 25-year view on your country, you've got to be sure that from a political point of view, you've got the stability, and from the regulatory point of view, you've got the certainty that no one's going to come and change our minds and say, well, actually, we want to renegotiate the contract that you signed X number of years ago. So we see just the bucket of infrastructure, whether it's renewables, whether it's toll roads, whether it's harbors, whether it's storage, those to us are probably the biggest opportunity. Obviously, power from an economic impact point of view is probably the most impactful one. Whether you're in Nigeria and you've got power cuts, or in South Africa or you've got load shedding, you just realize that without a stable and a reliable power supply, it's almost impossible to do anything meaningful in terms of your industrialization of your economy. So when you look at the amount that is required in those sectors, it's just mind-boggling in terms of the size and the quantum that are involved in that. So those are sort of opportunities that we see in the space that we play.
Okay, going back to Kabelo. Kabelo, I've seen a lot of pension funds across Africa. When they talk alternatives, I think the first port of call is private equity. Why do you think, I know you alluded to the fact that there's no information maybe on more complex asset classes, and pension funds also, they are considering issues of liquidity issues. But what would be the guideline that you could give an audience like this of pension funds comprising of the whole African continent, or most of them? What would be the guideline in going into other asset classes within alternative? What should they look at, and what should they talk to their consultants? Pushing those decisions into alternative. What should be the key things to look for?
Yeah, no, thanks, Steve. I think that's a really important question. Ultimately, one almost has to take a step back and just sort of assess when you're constructing a portfolio. Your key objective is obviously looking at making good returns. The adage, you never want to put all your eggs in one basket, is something we're all very familiar with. So from a volatility perspective, you want to protect the growth within your fund. You want a certain level of liquidity, as I'm sure a lot of our colleagues are aware. This year where there've been a lot of retrenchments and job losses, asset allocation becomes very tricky. You want a fair amount of long-term, debt through bonds, listed portfolios. But even then, the growth within the listed market or space has been, let's face it, it's been somewhat subdued in the last sort of 18 months or so. So the idea is you want to protect your capital. You want to outperform your benchmarks. You want to beat inflation and still have some sort of meaningful social impact. And for me, I think those are sort of the key guiding principles. you know, you as principals have a fiduciary duty to your members, and as such, you know, the responsibility lies with the boards of trustees to ensure that portfolios are balanced, and that they take into account the various risks. You know, so it becomes important to diversify, to look at different instruments. You know, I obviously am within the private equity industry, so that's obviously my bias, given the growth that's as an industry one has seen. And in fact, you know, by virtue of, I'm going to take you back to 2008 during the sort of global financial crisis. A lot of the recovery from some of the reports that I've seen came through from private equity firms and fund managers. And a lot of that stems from the fact that fund managers, remember, are intricately involved in the strategy and the operations of the businesses that they invest in. So it's not passive by any stretch of the imagination. Private equity is a very active asset class. And from a return perspective as well, if a fund manager doesn't achieve, you know, the preferred hurdle or return over a period of time, you know, they don't get to participate in any outperformance. So it's very much within the interests of, you know, both investors, you know, pension funds, as well as the manager, to ensure that the assets that they look at, you know, from a projection perspective, are able to sort of outperform. So another trend that I've seen as well is a lot of fund managers typically would be generalists or sector agnostic, but investors are now looking for very specific technical expertise and skills. So you know, the point that was made earlier, you know, that there is a opportunity within infrastructure, for example. So you have a lot of specialist infrastructure fund managers that just do and just specialize in infrastructure, or healthcare for that matter, or food security. So you know, I think the point really is to say, you know, we have a world of opportunities, some good, some bad, but ultimately, you know, the guideline should be around, you know, creating decent returns for your members and diversifying your risk to avoid any sort of, or to mitigate against volatility in certain markets.
Okay, going back to Simoli. Simoli, are you still there?
I'm still here.
Okay, I wanted to find out just your own opinion on risks. What sort of risks should pension funds, the trustees who are here, principal officers, what risks should they consider when they are even considering alternative investments in Africa?
So I think, as I indicated earlier on, you need to think about political risk. You need to think about the currency risk, also depending on where you are investing. Like Derek mentioned, some of these countries, you go in, invest in a project that's going to take 20 years, but the government changes after three years. The new government comes in and says all the contracts that were signed by the previous government are no longer relevant, or are can no longer be enforced. So those are the kind of risks that, as pension fund custodians, trustees need to look out and consider.
Okay, going back to Derek, Derek, I know you, Stanley, you've done a couple of African investments. I just wanted to get a view of what kind of impact, we discussed this earlier on, what kind of impact have your projects had, you know, some sort of ESG considerations when you go into an infrastructure project, let's say in Kenya or in Congo or in Zambia? What kind of impact do you incorporate in those projects? Derek, your audio is off.
Sorry. We have pulled back on doing projects in infrastructure outside of South Africa. For the next year or so, we are concentrating on specific sectors in South Africa. We haven't had the most useful experience and best experience in trying to invest in long-term projects outside of South Africa. So I can't really talk about anything outside of Southern Africa. But our experience really is as follows, is one, in countries where there is instability of government and lack of policy certainty, it is not a good idea to be deploying long-term money in those countries, particularly if it's foreign money. If it's domestic money, maybe it's different, but if it's foreign money, you've got to be very careful as a potential investor in those countries. So that's the first thing, politics and uncertainty of policy. The second one is obviously the ability to take your money out. If you put money in, you want to be able to get it out either in the form of dividends, or for that matter, when you finally list or you sell your investment, you want to be able to repatriate your needs, your proceeds. The third one is ability to exit some of those investments. If you don't have a vibrant capital market that can absorb some of those projects, you end up being stuck with them for a long period of time. You can try and sell them to other investors if you're lucky, but the space that we're in, there's not that many big infrastructure investors. There's ourselves, there's maybe Harith investors and African investment managers, which is owned by Old Mutual. And so the ability to exit some of these projects in non-South African territories has proven to be difficult for us. So we've just taken a view, which is, for now, let's concentrate on doing a good job in South Africa. At some stage, we do have an allocation of about 10% of our fund to non-South African vehicles, and then we'll revisit the non-South African vehicles when we are a lot more comfortable. We are just, I think as investment managers, our first and most important rule is we do not want to lose investor capital. That's protection of capital is the fundamental issue that we focus on. And then obviously the return will come on top of that. And where we can't be sure that we can protect investor capital, I can't allow the team to do that as a fiduciary. I'm responsible for other people's money, and if I can't be certain that it's going to come back, it's not going to get invested.
Okay, Derek, just hang in there. I've got a question online. It's from Derek. No, it's from Adam. He's asking you in terms of infrastructure, how is Stanley doing this, and which instruments are you doing this to gain exposure to the various types of infrastructure?
Sorry, I didn't actually get that clearly. You mind just repeating that for me?
Adam is asking in terms of infrastructure, how is Stanley doing this, and which instruments are you guys applying to gain exposure to the various types of infrastructure?
Yeah, so we run a typical private equity fund, which is we get commitment from investors. They agree for a time period not less than 10 years to have their capital drawn down. And at the end of that, at the end of 7 years, we start realizing some of those investments with the view that at the end of 10 years, we must return the investor capital together with the growth that they have received. So it's not too different to any other private equity structure that is out there. The second thing is on the instruments that we use a combination of equity and debt. We are more equity investors. We do have other parts of Stanley which do infrastructure debt, but generally we're looking at equity. We believe that the equity is one which is a lot less contested. When you look at infrastructure debt, there are many other institutions who are willing to provide that, but there's not that many players who want to play in the equity piece. And so we feel that we play a more important role in the equity piece than in the debt side.
We have a question in the audience at this point. Okay, I will take the second question also online. Just give me a second. This one again is from Adam, and he's saying from all of you, you can respond, Cabello, Maurice, Simoli, is asking, what is the view from the panelists on African debt as an investment asset class, especially from an infrastructure perspective? Are you exploring any of this, and what potential of African pension funds to invest in African African debt? You could just, Maurice, you could go first.
Okay. Debt is quite an interesting asset class that has been growing, and from what I heard from Derek and Cabello and even panelists before, Africa has a $70 billion infrastructure gap per annum. So, you've got the different funds being raised, Derek and them, $5 billion here, Cabello and them, a few $1 billion there. But would we actually ever reach that 70 billion that's needed? And are we perhaps doing small-scale infrastructure projects that are not really bridging that deficit? That's one of the big worries that I have about directing a lot of money into infrastructure. But on the back of that, debt is an interesting thing because it allows you to mobilize investments from foreign investors in particular, who are sitting in markets where they're either earning negative interest rates or negative yields, or very low yields, and they may be looking for high, attractive yields for them to get exposure to. So what I would say is, mobilizing foreign debt has a few nuances to it. I think one of them is having debt that's denominated in foreign currency, so that being US dollar, Chinese yuan, or euro. So it eliminates for those foreign investors the exchange control or the exchange risk that they have, and then allows them to really fund African infrastructure projects. But the second thing is the burden that debt could have on the fiscus and government investments. So local pension funds can mobilize their money into infrastructure projects via debt, and may be better because not all pension funds are big or large. As we would expect, there's a lot of small pension funds who may not be able to allocate $1 billion into infrastructure. So it may be good for them to jump on the bandwagon of a debt instrument, a debt ETF, a debt private equity, and then be able to participate even in hard currency in some of the infrastructure projects taking place. The last thing that affects debt is credit ratings. And your Fitch, your Moody's are not particular fans of Africa. Most of Africa's sovereign debt is sitting between B minus up until triple B minus. So it's really just on the edge of investment grade, and then also on the edge of default. So it's quite a you could call it a speculative spectrum to look at. But the yields are there because of that gap being so big. The yields that you get from African projects, and particularly financed through debt, are fundamental. So, I mean, from a listed point of view, we trade, we're about to start trading some hard currency debt, Africa hard currency debt, which predominantly trades in Europe and those markets. There is domestic debt, which a lot of the pension funds subscribe to, whether prescribed or by choice, but they do then buy up a lot of the local currency, local interest rate government debt. So to the private equity managers or unlisted managers, they may have a view of how they structure their infrastructure projects, but for us to really match that gap, the two big spenders in African infrastructure as it stands is governments making up about 40%, and then you've got China, which is making up about 25% of Africa's infrastructure spend. So the preferred method of doing that, and I think the more sustainable method of being able to do that and attract flows, is really going to be through debt.
Okay, Kabelo?
Yeah, no, that's really insightful. Thank you. I think from my perspective, as someone in the private equity sector, the moment one talks about debt, it's kind of the safe sort of asset class, so to speak, in the sense that you kind of know what your return is going to be, what your interest is, what the fixed maturity date is, I think from a return perspective, it's kind of, in the current climate, I think interest rates tend to be on the low end. So from a return perspective, if you want certainty, I think debt is kind of seen as, the safe sort of option. From my perspective, though, I think, the opposite of that, or equity, as we all know, is obviously a lot more sort of volatile. But the beauty with that is that, it doesn't necessarily have a fixed maturity date. So even with private equity, even if you happen to be invested in an asset class or an asset which is consistently delivering good returns, there's no reason why you can't continue to stay, with that asset. Whereas, as I say, with debt, it tends to have a fixed maturity date, and the potential for any sort of upside return is from certainly where I'm sitting, seems to be non-existent. So do we need debt? Absolutely. I think the benefits from a portfolio allocation perspective, it makes sense to allocate a significant part of the portfolio to safe assets, such as debt. And again, when one is looking at sort of infrastructure projects as well, you want a sort of blended financing type of investment, where you have a portion of senior debt, you have equity, and perhaps some sort of a mezz facility as well.
Okay, no, that's great. I just wanted to get, before we close, Derek's comment on something that this panel is actually very skewed towards South Africa. Sandeep left and the other two guys didn't show up. Derek, South African funds and investors are quite jittery about amendment to Regulation 28 proposed. I just wanted to hear your comments, where government is thinking of making an amendment to allow funds to fund social infrastructure, for instance. What would be your comment on that?
Well, I mean, there's nothing new there. As we sit here today, funds are allowed to invest in infrastructure. Up to 5% of any fund in South Africa can invest in unlisted, and under the unlisted, they can put whatever they want into infrastructure and into other asset classes, which form the part of being unlisted. So I think the debate that's taking place is that, is this a form of pressuring pension funds to invest in sectors or in projects that they otherwise would not invest in. So that is the real debate. And fortunately, the way the legislation works in South Africa is that you can't just wake up and put something onto legislation. There is a process that you follow to promulgate law, to take it through Parliament, where there are structured hearings from different parties before it actually becomes law. And because we've got such a strong constitutional and judicial framework, there are ways of challenging all kinds of laws which people feel that are not proper. And so I think the real issue here is that as custodians of other people's money, we all have to balance the need for social upliftment and a reasonable returns for for the people who have appointed us. And that's always a tension. We are very concerned about what we can return to our investors, and we focus exclusively and very hard on making sure that we don't fail there. But savings play a very important role in the economy. And so there's always going to be that tension, which is how can you use the savings pool in every country to advance some economic objectives? We believe that is a fair question to ask, but we disagree with the fact that it has to be legislated that pension funds should invest or be obligated to invest in certain projects. I think we should work harder at making sure that we create the flexibility for funds to be able to invest in the.
Oh, there you
Stephen?
Yes, I can hear you. You are all back online.
We thought we.
Yes. So I'm just going to ask the audience if you got questions. Peter, if you could help me here. Peter, yes, sir. I just need a mic to that side. So that is one thing. Thank you. We've got a couple of questions, so let's make them brief. Just do your intro, Peter. Is at the back. At the back. You just do a quick intro and you ask your question directly to the person that you want to respond, because we are 40 minutes late.
Good afternoon. Thank you for your presentation. My name is Matthew. I just wanted to check from you panelists that are you subjected to some rating system on different portfolio management?
We can't hear the question.
Okay. Can you hear me now? Hello?
Okay, you could ask, then I could shoot into that. Okay.
Yeah, what I wanted to know is they subjected to some rating in terms of portfolio performance and or management.
In all those various investments in various investments which they are subjected to, so that if whoever wants now to invest in with or use those pension or retirement funds may know in which
Hear anything anymore?
I can't hear anything either.
Yeah. I think they went offline, but it looks like they're back.
Okay,
Yeah.
can you hear me?
Yeah.
Okay, the gentleman is asking if there is any kind of rating on these investments, so that when you are going into certain infrastructure investment, you could maybe have like a benchmark of some sort, if that's what the gentleman is asking. Do we have some ratings that can guide us in these investments?
From experience, most of the ratings that investors rely on is the sovereign rating or the country rating, either by Fitch or by Moody's, to look at a country overall. When it comes to specific projects, I don't believe there is a house that provides the same type of quality and assurance on those ratings. So it's really then about the skill and track record of the manager who is managing the money.
Okay. Do we have any other comment on that?
Yeah, look, I think I would agree with Maurice as well. I think you know, indeed, you know, given the unregulated nature of a lot of alternative assets, you know, effectively one is really supporting the manager themselves. So based on past and historical performance, that's really, you know, what the allocation or investment is based on.
Okay. Do we have another person? Okay. Try to speak up loud and introduce yourself.
Thank you. Good afternoon. My name is Elson Goni. Mine is not a question. I just like the conversation on alternative investment. I am from Zimbabwe, and as an industry, the pensions industry, we have taken a deliberate effort to focus on alternative investment. And thankful to our president, who is saying Zimbabwe is open for business. And Zimbabwe is agro-based in terms of the economy. So far, we are focusing on pick and nut production in terms of alternative investments in the pensions industry. So for the funds that are prepared to work with us, we are open for business. Thank you.
Okay, I think that was more of a comment on what is happening in Zimbabwe, opening up kind of opportunities in the agribusiness. Do we have a specific question that somebody has?
If I may comment on that quickly, Zimbabwe is in the listed equity markets, it's being a very tricky place to invest. And you know, with Derek and I think Cabello could also share sentiments that it's been one of the more high risk countries to invest in, but it does offer a lot of potential. A lot of
Hello?
the country and a lot of
Okay, I think the connection there is not very stable.
Advisable for them to have a higher tilt to alternative investments, just given the lack of stability in the listed markets.
Okay, but Maurice, maybe you could repeat a bit on that. We lost you a bit.
Okay, I was saying I think some of my other panelists may agree that Zimbabwe is being one of the high risk countries. And this is when you look at the listed equity markets and the Zimbabwean Stock Exchange, etc. They've also listed a new one, Victoria Falls Stock Exchange. But it may be right and better for some of the pension funds, in particular for the members, to look at alternative investments within the country. So pecan nuts is a good one, but there is also mining. And there is some significant lithium deposits, hard rock lithium deposits in Zimbabwe. We've also been approached about that and to potentially look at that. And where you look at how the world is shifting, in the next 5 to 10 years, even if you look at just the likes of Tesla, lithium is going to play a very vital role in the future world and in terms of mobility. So it would be good to see some of the pension funds there, maybe almost on a case study basis, tilt more of their portfolio into alternative investments as a means to be able to generate industry within the country.
Okay, that's great. That's great. Let's take the last question. I think this panel needed some more time. Do we still have Simone in the background?
Good afternoon, the panel and the team here. This is Matthews Chavala. I just want to echo on Kabelo's sentiments when he talked about constructing the investment portfolios. It's fundamentally important to know the key objective. And we know that the key objective is to get the returns or reasonable returns. And it's also imperative that we need to identify the threats or to constrain the threats to achieve the objective. That's where the issue, because we saw domiciled on certain investment portfolios, like we so traditional. That's why we've got this fear of unknown to failing to explore the opportunities. So from my perspective, it's important that we need to also classify our the risks that are associated with the investment portfolios from the external context, which we can use maybe based on which is political, economic, social, technological, legal, environment, or ethical. Once we have that external context, we can able to explore the opportunities. And it's important that when we manage the risk, we'll seize the opportunities. Also from the internal context, what is happening in our investment portfolio, we can use also the firm risk scorecard, which is financial infrastructure, reputational, and marketplace. So we need to ensure that we manage this risk to seize the opportunities. I thought I should also maybe share my thoughts pertaining to classes of investment and asset allocations. I thank you.
Okay, I guess that was more of a comment. Kabelo, you got that, and Maurice? It's like Derek has dropped out.
Yes, indeed. No, I think that's a really relevant question, and I'm glad the audience is taking a more considerate sort of view around alternatives, and I think we need to have this conversation more often. But the reality is, it's a diversification game. You want to protect your capital. Ultimately, you want to outperform your benchmarks, and you want to make some sort of a social impact. But you want to do so in a manner which attracts or mitigates risk as far as possible. So there's a lot of guidelines, and yes, it's relatively uncharted territory within our continent, but the opportunities, like Derek had mentioned, around industries like infrastructure, renewable energy, green technologies, food security, e-commerce, fintech, the list is endless. So the fact that you are stimulating all of these different economies and all of these areas for growth through alternative investments, one, it means that you're spreading the risk, but two, it also means that you're actively stimulating those businesses, all those entrepreneurs, all of those SMMEs, you're contributing to the growth of, respective countries and continent as a whole. So it's a conversation that needs to be had, and I hope this is the start of ongoing consideration of alternatives. Yeah?
Okay, no, that's great. Thank you very much. What we will be doing, we are partnering with MN Capital. Maurice is very familiar with MN Capital, and we'll also get a lot of input from Maurice himself. We're going to be doing country-specific infrastructure-focused sessions, COVID allowing us, Botswana, Zambia, Kenya, Zimbabwe, but purely infrastructure-focused. So we will be inviting you, we'll be talking to you, Kabelo. Hang in there. We need to have coffee by the time I get to Joburg. Can you hear us?
I look forward to it, or a beer.
Okay, great, great. Okay, thank you very much. Let's appreciate our panelists. Simone, I think he's in the background. Derek, thank you very much for making time. We'll see you soon.
Thank you, and all the best with the rest of the sessions.
Okay, thank you very much. Okay, so we've actually, I think, run 1 hour out of our schedule. Luckily, Nicola is here. We're gonna talk to her for our next presentation. We're gonna bribe her so that she can wait for us. So let's just dash to have lunch. Then we try to reschedule Nicola and Zamani, who are supposed to be next in our presentation. Thank you for your patience. And let's get back. If you can do 30 minutes lunch, will be better so that we don't go late in the evening.